In the world of finance, particularly in emerging markets like India, the Nifty is a term that frequently surfaces. It's often discussed in news headlines, investment forums, and by market analysts. For those new to the complexities of financial markets, understanding what a Nifty contract means can seem daunting. As someone who appreciates clarity and structured understanding, similar to how we break down complex projects, let's demystify the meaning of a Nifty contract in simple educational terms. What is the Nifty first? The foundation. Before we dive into Nifty contracts, it's essential to understand what Nifty itself represents. Nifty is short for Nifty 50, which is a leading stock market index in India. It stands for National Stock Exchange 50. Think of it like a report card for the overall health and performance of the Indian stock market, specifically focusing on its largest and most actively traded companies. Benchmark Index. The Nifty 50 is India's premier benchmark index. This means it's widely used by investors, fund managers, and analysts to gauge the general direction and performance of the Indian equity market. Top 50 companies. The index comprises the top 50 Indian companies across various sectors that are listed on the National Stock Exchange, NSE, based on their free float market capitalization. These are typically large, well-established companies, often referred to as blue-chip stocks. Market representation. Because it includes 50 diverse companies, the Nifty 50 provides a broad representation of the Indian economy and its key sectors, such as financial services, information technology, oil and gas, consumer goods, and more. Calculation. The index value is calculated based on a free float market capitalization weighted method. This means that the influence of each company on the index is proportional to its market value that is freely available for trading, not held by promoters or governments. So, in essence, when the Nifty 50 goes up, it generally means that the share prices of these 50 large companies, and by extension the broader Indian market, are performing well. When it goes down, it suggests the opposite. Entering the world of Nifty contracts. Derivatives. Now that we understand the Nifty 50 index, let's turn our attention to Nifty contracts. These contracts are part of a financial category called derivatives. A derivative is a financial instrument whose value is derived from an underlying asset. In the case of Nifty contracts, the underlying asset is the Nifty 50 index itself. You are not buying or selling the actual 50 companies. Instead, you are trading a contract whose value moves in relation to the Nifty 50 index. There are primarily two types of Nifty contracts traded on the NSE. Nifty futures contracts. Nifty options contracts. Let's explore each one. 1. Nifty futures contracts. A Nifty futures contract is an agreement between two parties to buy or sell the Nifty 50 index at a predetermined price on a specific future date. Obligation. The key word here is obligation. If you enter into a Nifty futures contract, you are obligated to complete the transaction on the expiry date, regardless of the Nifty 50 index's actual price at that time. Predetermined price. When you buy or sell a futures contract, you agree on a price today for a transaction that will happen in the future. This price is called the futures price. Expiry date. All futures contracts have a specific expiry date, typically the last Thursday of a month, though always verify current exchange rules. On this date, the contract is settled. Cash settled. Nifty futures contracts are cash settled. This means there is no physical delivery of the underlying 50 stocks. Instead, the difference between the agreed-upon futures price and the Nifty 50's actual closing price on the expiry date is settled in cash. If you bought at a lower price and the Nifty goes up, you make a profit. If it goes down, you incur a loss. Leverage. Futures contracts involve leverage. You only need to put up a small percentage of the total contract value as margin to control a much larger position. This amplifies both potential profits and losses. Purpose. Traders use Nifty futures for two main reasons. Speculation. Betting on the future direction of the Nifty 50 index. If you expect the Nifty to rise, you buy a futures contract, go long. If you expect it to fall, you sell a futures contract, go short. Hedging. Protecting an existing portfolio of Nifty 50 stocks from potential downturns. If you own many Nifty 50 stocks, you might sell Nifty futures to offset potential losses if the market drops.